Hi all. The topic for this video is carry trade, and the reason why you should be knowing about this is this will help you to understand why foreign institutional investors will invest in India, or why should they invest in India, or when they will not invest in India. That concept clarification, this video will help you to understand. Okay, so now what is carry trade? Now, carry trade as in you will borrow from your country or from your market of low yield. Okay, so for example, you are borrowing from US at 2%, okay, rate of interest. So you are borrowing $100 at 2%, and you will invest in. So after borrowing, you will invest in a country of high yield. Okay, you will invest in a country of high yield. Example, let's say India, where let's say 10% fixed rate they are going to get. Okay, so when will your company do this? We keep hearing foreign institutional investors investing in India or not investing in India. So let's try to understand this. Let's say this is the case, this is the scenario where $1 is equal to, let's say $1 is equal to 80 rupees. So $1 is equal to 80 rupees. Now, yeah, an investor, he's seeing the opportunity over here. In US it is 2%, and in India it is a 10% rate of interest. He borrows $100 from US at the rate of 2%. So that means after 1 year he is supposed to repay $102 to the bank. Okay, he's supposed to repay $102 to the bank. Now he converts this $100 at the rate of 80 rupees. So $1 is giving 80 rupees. So 100, so he is borrowing $100. So $100 would be 8,000 rupees. So he has got 8,000 rupees. Now this 8,000 he is investing at the rate of 10% interest. Okay, so when he is getting 10% rate of interest, after 1 year he will have 800. 800 is 10% of 8,000. So he will have 8,800. He will be left out with 8,800 after year 1. So now you see what happens. He will bring that amount back to US. So when he brings that amount back to US, $1, okay, $1 is 80 rupees, and so he has 8,800 rupees. So how many dollars will it be? So how many dollars? X dollars. So X is equal to, so you do cross multiplication, 8,800 divided by 80. So that comes to $110. So he gets $110, out of which $102 he will give it to the bank, and remaining $8 will be his net profit. Remaining $8 will be his net profit. Okay, 110 he is getting, minus 102 he will pay to the bank. $8 will be his net profit. So this is called carry trade, where an investor will borrow from the market of lower yield, and then he will invest in the market of higher yield. However, there is a catch. This is not that easy as the way I have written over here. Reason being, here I have assumed that $1 is equal to 80 at the beginning, and even after 1 year it is stable at 80. But practically that will not be the case. There are two possibilities. Either the dollar will appreciate against the rupee, or it will depreciate. So let's say, for example, $1. So let's say $1 is equal to, let's say, 90. So rupee is depreciating here. So $1 is 90. So in that case, $1 has become 90 rupees, and he is going to get 8,800. So 8,800 rupees will give how many dollars? Sorry, will give how many dollars? So again, I do cross multiplication. It will be 8,800 divided by 90. So 8,800 divided by 90, that comes to 97.77. So let me just round it off to 98 for the convenience. So $98 he is going to get. However, he is supposed to repay how much? 102. So 102 is supposed to repay, and he has got only 98. So that means in this case he is at the loss of $4. loss of $4 in case rupee depreciates highly. In case if rupee depreciates highly, so that means, and in case if rupee appreciates, let's say here, next case rupee appreciates, so $1 is equal to, let's say it has come to 70, 70 rupees. I'm just exaggerating all these numbers a bit so that you can appreciate the differences. So once $1 is 70, so 8,800 rupees you are getting. So that comes to how many dollars? So I do cross multiplication, 8,800 divided by 70, that comes to, it comes to 125.7. So let me round it off to 125.7, like 126. So in this case, you see, he will give 102 to the bank and he will get 126. So you see how his profit is jumping. It comes to $24 his profit. $24 is the profit. So wherever he is investing, he will expect that particular country's currency, that market's currency, to appreciate. Okay, and that is possible only when the economy. I mean, only when the market, only when that particular market is doing very well. The economy of that particular market is doing well. Say, for example, if Indian market does really well, and if it appreciates, he is going to get excellent returns. And in case if it depreciates highly, if it goes to 90, then a company would not like to stay invested in that country, and then they would like to take their money back to their country. Otherwise, this is the case, they will have to incur losses. Okay, so this is an example to help you to understand that why why investors will invest from US into India. It's called carry trade, investing from low yield, borrowing from low yield and investing in high yield. Hope this helps you to understand about carry trade. Thank you so much for your time. Thanks a lot.